Hi guys, welcome to my YouTube channel. This is Tashwita Gupta, your tutor for FR, SBR and Diploma IFRS at WIFI. So today, as I promised, this is our last lecture for technical articles which are important for your March 2023 attempt. So today we are going to cover APMs, that is alternative or additional performance measures, and we will discuss onerous lease contracts, debt versus equity, that's another technical article in your syllabus. So we'll have a proper discussion on these few technical articles. So now let me just tell you that this is not something which is you can say very complex. It's a theory or it's something you've already done, but they've just twisted the word. Some concepts are, you can say, modified for you to actually write an answer if it ever comes up from these technical articles. So that means you've already studied them. It's just that it will be, the technical article is written in a different form. Concept is same, form is different. So first of all, what are these alternative performance measures? So in the question number 4 of your SBR paper, you will be asked about this if it ever comes up, that APM basically are more like your performance indicators or performance measures. Now all of you have done your KPIs, that is key performance indicators, remember? Now those KPIs were in FR, right? That is your ROCE, return on capital employed, your ROE, return on equity, then you had your net asset turnover ratio. So many things were there in your KPIs which were like given to us in a pre-format. We have the, you can say, formula given to us by IASB that this is how you actually interpret the financial statements. This is how the ratios you use: ROCE, ROE, net asset turnover, gross profit margin, net profit margin. We all have done this when we were children, right? But this one is a little complex, APM. So APM are basically the measures of financial performance not specifically defined by the applicable financial reporting framework. Now, if you ask me, ma'am, how much profit do you generate? So what I'll do is, I will say, okay, this is the revenue that I generated from my consultancy firm, and because I was involved in certain type of investments, so there were fair value changes on my financial assets which are not relevant to my operations. So if I exclude them, this is my profit. So maybe I made an investment in equity shares and I made a loss on them. So what I'll do is I will exclude that loss and tell you this is my operational profit. So what basically I'm doing, I am making my alternative or additional performance measures. So this is basically given to increase or enhance users' understanding. I have been saying this again and again that what matters to us is users' understanding, investor perspective, right? So it is not that I have to just report what the standard says. I have to focus on what user wants, what is beneficial for him, right? So all measures designed to illustrate the physical performance of the activity of an issuer's business. So they are basically designed to exclude all the extra effects. So if there was an impairment, now you would say that impairment may be because of external factor, but that is not related to our performance, right? If it is an impairment because of COVID, that is not related to the business performance. So that's why you exclude that. So we have such, you can say, measures through which we calculate our earnings before impairment, excluding impairment, earnings before interest, earnings before tax, and even amortization. Sometimes depreciation is excluded because again that is an automatic process. It's not something related to performance of our company. So APMs are more or less related to physical performance of the business. Then all measures disclosed to fulfill other disclosure requirements included in public documents containing regulated information. So all of these measures, which are the APMs, are disclosed to fulfill other requirements. That means, for example, there is a disclosure requirement that you have to provide this information, that what would have been your earning if this thing was not there. So basically you are type of doing some enhanced reporting. So you can say if I give certain APMs, I am being specific to my performance. So I am reporting my financial capital, right? So you've done that in integrated reporting. We have 6 types of capital. One of them is financial capital. So when I give such enhanced disclosure of my finance, where I'm giving the actual figures in my SFP and SPL, plus I'm also giving certain disclosures which are adjusted performance measures, then it is included in all the public documents, right? So these are what APMs are. So let us take an example. It is from your technical article only. Okay. So they said that it was used by telecom company Italia, EBITDA, that is earning before interest, tax, depreciation and amortization. So you are excluding interest, taxation, depreciation and amortization, right? So used by telecom as the financial target in its internal presentations and in its external presentations to analysts and investors. So that is their target. Their target is not to save tax, save interest, or to avoid depreciation or amortization. That is not possible. Their target is to increase their other earnings, which is related to operation. So the entity regarded EBITDA as a useful unit of measurement for evaluating the operating performance of the group and the parent. So that is according to entity's judgment. This is according to the company in question, its judgment. So everyone will have different judgment, which means everyone will have different APMs. If everyone have different APMs, it becomes a subjective issue, relative issue. Everyone will be valuing things in a different way. If that happens, then what arises is known as inconsistency, right? So incomparable, inconsistent, all these things give rise to many issues which are against the conceptual framework, because of which we are discussing these days that we should have a proper framework through which we can get a guidance on APMs only. So there are many benefits of APM, but there are also many disadvantages. So just think yourself, what can be the advantage? Enhanced disclosure. Then you can say focus is focus oriented, where we are just focusing on the operating activity. We are not discussing about any other irrelevant things. So operating activities, we are focusing on that only. Then what else can we include in this? You can talk about one more advantage, that when we are doing this, our the trust of the investor increases, because we are basically you can say making the information understandable for them. Then on the same hand, we can also talk about the disadvantages, that it is subjective, inconsistent, incomparable, plus sometimes it's complex for the user, that what is this EBITDA, like you all guys are confused, right? Then these are the advantages and disadvantages of APMs. So here I have given few examples, like what the company used. Organic change in revenue, for that they use EBITDA and EBIT. Then net financial debt, what they included in net financial debt, they are making their own names, making their own formulae and presenting it. So that's what APM is, right? You just have your own judgment, own you can say knowledge, and you make a new measure. So telecom saw net financial debt as an accurate indicator of its ability to meet its financial obligation. It is represented by gross financial debt less cash and cash equivalents and other financial assets. So basically what they are saying is, you take the gross financial debt, that means whatever financial debt means whatever basically you have the assets, less any cash and cash equivalents and other financial assets. So if I'm to just look at my debt instrument, I will include gross financial debt, right? So the report on operations include two tables showing the amounts taken from statement of financial position and used to calculate net financial debt of the group and the parent. So basically how much loan you have taken till now, from that you basically deduct your financial assets and cash equivalents. So that's what they're doing. Now that doesn't make sense to us. It will be varying from company to company. So I cannot say that this will be there in your paper. So in your exam, the case study will mention that these are the APMs decided by the company, which they will give the name and they will give the formula that this is how it is calculated. Then they will say that there is a standard which is wrongly applied. Standards knowledge you all have, right? For example, if their IFRS 15 is wrongly applied, so it will affect your earnings, it will affect your EBITDA. How will it affect? So first you will calculate original EBITDA, then you will calculate adjusted. Like if I rectify my mistake, what will be my adjusted EBITDA? Then I will compare it to the original one, and that will give me one good product. That is my, you can say, new EBITDA, and how the movement is there. Whether it's a good thing or a bad thing. If I rectify my mistake, has the EBITDA increased or has it decreased? So you will basically talk about whether it's a good performance or a bad performance, right? So this is what basically is there in APMs. So APM is a vague area. It will vary from case study to case study, but yes, you should be aware of their advantages and disadvantages, right? So that is all about APM's current technical article. Then you have one technical article over debt versus equity. All you need to know from that is that what under IAS 32, what is the definition of debt? That means when you buy the bonds of a company. And what is the definition of equity? That is when you buy the shares of a company. Fine. So IAS 32 says that a financial liability is a contractual obligation to deliver either cash or another financial asset. So either I have to deliver cash, it is for sure, it's not voluntary, I'll have to do it. If I don't do it, I'll be sued, right? So either I have to deliver cash or other financial asset to the holder. Equity is any contract which evidences a residual interest in the entity's asset after deducting all of its liabilities. So my students who are enrolled with me at WIFI, you guys have done this. I discussed this in one of our grander visions. So basically this is equity is any contract, residual interest. So what is equity? When I buy shares, I buy interest, I buy a stake, I become a shareholder. So I buy a share in the net assets of that company. That's why in a joint venture, how do you calculate? If your joint venture is by 50%, which is mostly the case, so your share in the JV is 50% of the net assets of that joint venture, right? So basically you have a share in the net assets. So that's what equity is. Then however, a contract may involve delivery of the entity's own equity instruments. A contract which will be settled by the entity delivering a fixed number of its own equity shares in exchange for cash is an equity instrument. If there is variability, then we call it as financial liability. So if I am not sure how many shares I'm going to issue to a person, then that becomes financial liability. Example, convertible debenture, right? So if you issue convertible debenture, it is convertible to shares, but I don't know how much. So part of it is a liability and part of it is an equity. Now again, the board has not given any such explanation that why variable number of equity shares are financial liability and fixed number of equity share is equity. So there is no such discussion provided by the board, but yes, this is something which is there. So we have to, it is a rule based approach, we have to memorize it, right? So that is what debt is and that is what equity is. Then let's come to the next technical article, that is onerous lease contract. It's a very short and cute one. It also has, it's a very recent, the most recent technical article. It also has investor issues. So I will be attaching this PDF as usual, and in this PDF I will include some paragraphs which you have to read, which are investor issues. They don't require any sort of explanation, but you have to just give it a reading. No need to learn or anything, just read it. It's mere theory, Onerous lease contracts. Any contract which is onerous, what do we do with that? We create a provision on it, isn't it? Under IAS 37, I create a provision on all the onerous contracts. At what amount do I create the provision? Lower of cost to continue and the cost to terminate that contract. Cost to continue and cost to terminate. So this is how you create the provision. So you calculate the present value of the loss and then you create a provision for onerous lease contracts. So onerous contracts are recorded there and then. But the point is, if under IFRS 16 a contract is onerous, what to do? Now you know that our IFRS 16 was previously IAS 17, where in the lessee accounting also we had the operating and the financial leases, right? So in that particular case, what happens is that when it is a lease, we have to ascertain that we are doing lessee accounting on a line, like on, you can say, comparable basis. Everyone is doing the same thing. So we have to create ROU and we have to create lease liability. Previously we were not doing this because it was bifurcated between operating and financial on the lessee's account also. So what happened, that in operating leases we used to record it whenever we used to get the rent or whenever you used to pay the rent. So we used to record the rent paid or rent received. But now they said for everyone who's taking an apartment on rent, they have to include an ROU and a lease liability. So ROU, you all know how it is recorded. Initially it is recorded as lease liability plus any payment made on or before the commencement of the lease, right? And subsequently, what is our treatment for ROU? We will either keep it under IAS 40 if our lease is, like, if I've taken a building on rent. If I'm using it as investment property, that is I'm subletting it, so I will apply IAS 40 to this ROU. If I'm taking it for PP, that means for my manufacturing, production and everything, then I will, what will I do? I will include it in my IAS 16. I will apply the rules of IAS 16. Now the point is, if this is a loss-making contract, the question is, can I apply IFRS 16 and IAS 37 together? Right? So again, the board has not specified anything on this. So the International Accounting Standard Board decided not to specify any particular requirements in IFRS 16 for onerous contracts. That's why in IFRS 16 there was no specific column on onerous contract. So for leases that have already commenced, no requirements are necessary. So the leases which have already commenced, there are no requirements which are necessary. So commenced means lease contract is going on. We are living in rent. We are living on rent. We are paying the rent. So it is already commenced. So after the commencement date, an entity can appropriately reflect an onerous lease contract by applying the requirements of IFRS 16. A lessee will determine and recognize impairment of ROU applying IAS 36. So when the lease contract has already begun, that means it's already commenced, then I will not apply IAS 37. I will not create any provision of onerous contract. Rather, I will impair my ROU and deduct the impairment from the carrying amount of my ROU. Because what is onerous lease contract? Your ROU is less than your lease liability, right? So basically what is happening is there is an impairment of your ROU which you will consider under IAS 36, right? So you will give your ROU at the net amount. Then for the leases that have not already commenced, which are still or yet to commence, the requirement for onerous contract in IAS 37 provisions, contingent liabilities and assets are sufficient. The requirement in IAS 37 apply to any contract and hence any lease contract that meets the definition of an onerous contract in that standard. So now if the contract has not yet started, then if you think it is a, you can say, loss making contract, then you'll apply IAS 37 and you will create a provision, right? So this is what we have to do for our onerous lease contract. It is bifurcated: the contract which is already commenced, the contract which is not commenced. So the question also arises as to how to deal with onerous contracts when initially applying IFRS 16. So if initially we are applying IFRS 16, that is the contract has commenced, in that case, that is A case, how will we deal with this onerous contract? So we will apply IS 36 to its ROU, that's what I told you. Not apply IS 36 on the date of initial application, but instead rely on its assessment of whether any of its leases are onerous, any onerous lease provision is derecognized, and an equal amount is deducted from the carrying amount of the relevant right of use asset. So basically they are saying, how will you calculate that what is your impairment? In the A case, they said if the lease contract have already commenced, then you have to impair it and not create an onerous contract provision. Got it. Now how will I calculate this impairment? I will see that if I was applying IS 37, a little complex thing, if I was applying IS 37, what would have been my loss from this contract? Now that loss will be deducted from my ROU. That loss that you will calculate is your impairment. That will be deducted from the ROU and you will present it at the net amount. So this choice can be applied on lease by lease basis. So in the question, in the SBR exam, the examiner has written that it's not necessary that you have to give perfect answer. So you should be able to present this type of discussion that yes, see, mostly examiner will mention whether you have to create a provision on this or not. That means they will mention how will you apply IS 37 in this lease contract. That means you have to create a provision. If they don't mention it, then you have to yourself see whether the lease contract has commenced or not. If it has not commenced, IS 37 applies. If it has commenced, IS 36 applies. So that is all for your onerous lease contracts. So very soon I'll be attaching some readings from investor issues. That is very simple topic. You can just go through it once, and that is basically an end of our important technical articles which I consider very important for your March 2023 attempt. So now you know what APMs are, its advantages and disadvantages. Now you know what is the difference between debt and equity, and now you know how you deal with onerous lease contracts. So that's it, guys, and I hope these series were helpful. I've created a playlist for technical articles on SBR. If it was, kindly do like, share and subscribe to my channel, and all the best for your exam, guys. I hope your preparation is going good. Goodbye.